If you think the US economy is only about charts numbers and boring government reports, then pause for a moment and listen carefully, because what you're about to hear affects your job, your rent, your grocery bills, your savings, and even the future you are working toward. What if I told you that the strongest economy in the world is showing two very different faces at the same time, where stock markets are celebrating historic highs while millions of Americans still feel financial pressure every single day? Growth looks strong on paper, confidence appears to be returning, yet uncertainty is quietly building underneath. This is not just an economic update. This is a real story about money, people, and power. You're watching THI US Report, and today we are breaking down the true state of the US economy right now in a way that actually makes sense. Before we go any further, take 1 second to like this video and subscribe to THI US Report, because here we explain the US economy in simple language, without hype, without confusion, and without wasting your time. It helps the channel grow, and it helps you stay informed in a world where financial decisions matter more than ever. Now let's start with the big picture. The U.S. economy has surprised many experts by staying strong, even after years of inflation, high interest rates, and global uncertainty. Consumer spending has remained resilient, businesses are still investing, and economic growth has continued instead of collapsing. For many analysts, this strength has challenged the idea that a recession was inevitable, but strength does not mean comfort, and growth does not mean that everyone is doing well. Economic growth is usually measured by GDP, which simply means the total value of everything the country produces and sells. Recent estimates show that the U.S. economy grew at a solid pace, supported mainly by consumer spending, government investment, and steady business activity. On the surface, this sounds like great news. A growing economy usually means more jobs, higher incomes, and better opportunities. But when people hear these numbers, many ask a simple question. If the economy is growing, why does everyday life still feel so expensive? The answer lies in inflation and the cost of living. Inflation has slowed compared to its peak, but prices remain much higher than they were just a few years ago. Food, rent, insurance, healthcare, transportation, and everyday services continue to stretch household budgets. Even when inflation cools, prices do not usually come down. They just rise more slowly. This is why many Americans feel like they are falling behind even while the economy is officially growing. For working families, this creates constant pressure. Paychecks may be higher than before, but so are expenses. A trip to the grocery store costs more. Monthly rent takes a bigger portion of income. Credit card balances are rising as people rely more on borrowing to cover daily needs. These pressures don't always show up clearly in economic data, but they are very real in people's lives. Jobs are another major part of this story. The labor market has remained relatively strong, with unemployment staying low compared to historical levels. That is good news because jobs are the foundation of financial stability. However, there are signs that the job market is cooling. Hiring has slowed, companies are becoming more cautious, and layoffs, while not widespread, are appearing in certain industries. Many employers are freezing hiring or reducing expansion plans. Wage growth has helped many workers, but for a large number of people, wage increases have not fully kept up with rising living costs. Job security also feels less certain. Even people who are currently employed worry about automation, artificial intelligence, outsourcing, and economic slowdowns. When people feel uncertain about their future, they spend more carefully, save where they can, and avoid big financial risks. Over time, this behavior can slow economic growth. One of the most powerful forces shaping the economy right now is the Federal Reserve. The Fed controls interest rates, and its main goal is to keep inflation under control while supporting maximum employment. Over the past few years, the Fed raised interest rates aggressively to fight inflation. These higher rates have had a direct impact on everyday life. Mortgages became more expensive, car loans cost more, credit card interest rates climbed, and business borrowing became more difficult. Right now, the Fed is holding interest rates steady and watching economic data closely. Policymakers are trying to decide when and how to adjust rates without damaging the economy. If rates stay too high for too long, economic activity could slow too much. If rates are cut too early, inflation could return stronger. This balancing act is one of the most difficult challenges in economic policy today. Higher interest rates have hit the housing market particularly hard. Mortgage rates remain elevated, making home ownership less affordable for many Americans. Home prices have not collapsed, but sales have slowed and affordability remains stretched. First-time buyers face major obstacles, while renters continue to deal with high rents in many cities. Housing costs are one of the biggest reasons why people feel financial stress, even when economic headlines sound positive. Consumer behavior is another key factor. Consumer spending drives a large portion of the U.S. economy, and consumer confidence plays a huge role in shaping that spending. Recently, consumer sentiment has improved slightly, especially among higher-income households. People who own stocks, property, or other assets have benefited from rising markets, and that has boosted confidence for them. However, lower income households remain cautious and stressed. This creates a growing divide in the economy. While some Americans feel optimistic and financially secure, others are struggling to keep up. Credit card debt has increased, savings rates have declined, and financial buffers are thinner for many families. This uneven experience is one of the most important realities of the current economy. The economy is not affecting everyone the same way. Now let's talk about financial markets, because they tell another part of the story. The stock market has reached historic levels, with major indexes hitting milestones that once seemed impossible. This reflects strong investor confidence, expectations of stable growth, and belief that large companies will continue to perform well. For investors, this feels like validation that the economy is on the right track. But the stock market is not the same thing as the real economy. Markets reflect future expectations and corporate profits, while everyday life reflects wages, prices, and personal expenses. Stocks can rise even when people feel financially squeezed. This disconnect often creates confusion and frustration. People see record market highs on the news, yet feel no improvement in their own financial situation. Global trade and international policy also play an important role in shaping the U.S. economy. Trade agreements, tariffs, and geopolitical tensions influence prices, supply chains, and business decisions. Higher tariffs can increase the cost of imported goods, which eventually leads to higher prices for consumers. Trade relationships also affect manufacturing jobs and long-term economic competitiveness. Manufacturing activity has shown signs of improvement, with factories reporting stronger output compared to previous periods. Government spending on infrastructure and domestic production has supported this trend. However, long-term success depends on stable demand, efficient supply chains, and global cooperation. Technology is another powerful force shaping the future. Artificial intelligence is transforming industries, increasing productivity, and changing how work is done. Businesses are investing heavily in AI to reduce costs and improve efficiency. While this could support long-term growth, it also raises concerns about job displacement and inequality. The economy may grow, but the benefits may not be evenly shared unless policies adapt. Looking ahead, most forecasts suggest that economic growth may slow slightly but remain positive. This is not a collapse scenario, but a transition period. Risks remain, including persistent inflation pressures, policy uncertainty, global conflicts, and financial market volatility. The economy is walking a narrow path between cooling down and slowing too much. What matters most is how all of this affects real people. For workers, it's about stable jobs and fair wages. For families, it's about affordability and peace of mind. For businesses, it's about confidence and investment. And for policymakers, it's about making decisions that support growth without increasing inequality. The U.S. economy today is strong, but fragile. Strong because it continues to grow despite challenges. Fragile because confidence, affordability, and long-term stability remain uncertain. This is not a simple success story, and it is not a disaster story either. It is a complex moment of change. If you have listened this far, you now understand the U.S. economy better than most people who only follow headlines. This is exactly why ThaiUS Report exists, to explain what is really happening in a clear and honest way. Now I want to hear from you. Do you personally feel the economy is improving, or does life still feel harder financially? Share your thoughts in the comments, because your experience matters. And if you found this breakdown useful, share this video with someone who wants to understand the U.S. economy without confusion or noise. Your comments and shares help this channel grow and help more people stay informed. Thank you for watching ThaiUS Report. Stay aware, stay informed, and I'll see you in the next update.